Day Supplement live with me, Adam Lawrence. So I'm also going to be welcoming people on the Property and Poppadoms Facebook group. If you're not already members of that Facebook group, I highly recommend it. So a bit of Propenomics and Poppadoms for the Property and Poppadoms people as well. So what am I going to be talking about on this week's live? Well, I'm going to be going into, apart from anything else, Trumponomics. I've been keeping a close eye on Mr. Trump since he's got back into the White House for obvious reasons. And you can see why over the last few weeks, apart from anything else. But mortgage rates all over the place. Possible impact of all of this. Will it be rates down in the US and up in the UK? Worth thinking about. If you haven't watched one of these before, you'll know I like to start with a quote. And this week's is, we are navigating a global economy that is structurally different, not just cyclically delayed. The old playbooks will not work. And that's from Mohamed El-Erian, probably the most preeminent economist in the world, I would say, at the moment, and certainly a practitioner as well as an economist, apart from anything else. So if you never see a rich economist, I suspect Mr. El-Erian's got a pretty reasonable net worth. Mr. Buffett, you might want to change your thoughts on all of that, but let's see. But as our calendar advances through the golden quarter, myself and Rod's next property business workshop is live. Tickets are selling well. This is about structure and exit. That's yours and also others. And if you've got no exit plan, you're going to go out one way or another. So things have changed with pensions being brought into the scope of your personal estate. What does this mean for SaaS apart from anything else? This is according to people that use them and not selling the product ultimately. So you'll get an objective viewpoint from us. Join us on the next property business workshop, Manchester, Central Manchester, Wednesday the 22nd of April. tinyurl.com/PBWTEN, and there's a link in the show notes as well. So Trumponomics first up. Well, the war rolls on, doesn't it? Volatility is very much the watchword. Some large single and small double-digit gains and losses on oil price over various days over the past couple of weeks. The market really can't make its mind up. A recent podcast I listened to, which is The Rest is Money, Robert Peston and Steph McGovern, one that I quite like. That had Mohamed El-Erian in, and that's where I took this week's quote from. He said that the market is issuing about an 80% chance at the moment, or pricing in an 80% chance of a relatively swift end to the war with a return to business as usual. But he himself suggested the probability that was probably closer to 50% than 80%. So both he and Peston thought that the market wasn't being bearish enough, or wasn't there with reality quite where it needed to be. But then Peston, if you look back over these sorts of situations, is extremely, at least very enthusiastic, if not a bit of a perma bear in these situations, to be honest with you. But El-Erian, highly respected and well worth listening to. And then alongside this, the US Trade Representative started an investigation into 60 major economies, including the UK, looking for forced labour and manufacturing overcapacity. Sounds like reasons for more tariffs to me if you get stuck into the laws over there. Tariffs are being removed on goods under $800 from the US side, but the UK side is still looking at implementing them. This was talking about being protectionist when it comes to businesses like Temu and the likes, taking a lot of business away from UK companies, or probably Amazon realistically, but of course they do. There are other places to buy goods and products, of course. That had been praised to protect these domestic producers of cheaper items. But, a week or two is a long time in politics. And then tariff fatigue is being ascribed to 33% of companies, according to a British Chamber of Commerce recent survey. Basically, it delays investment decisions. Trump hadn't said anything nasty for a few days, although he had said plenty about our Prime Minister, apart from anything else, whereas Keir Starmer prefers more traditional diplomacy, aside from anything else. So what we can't miss is the US's latest solution to the fallout of this conflict. A 30-day waiver on 128 million barrels of Russian oil that are currently stranded at sea. If they are really stranded at sea, who knows, right? That's $12.8 billion at $100 a barrel, straight into the Russian coffers alongside anything else. We're obviously caught up with prices at the pumps, apart from anything else. Nothing upsets people like expensive fuel. Navel gazing extraordinaire, to be honest with you, bearing in mind what's going on. But it must be nice if that's our biggest problem that we've got, ultimately, mustn't it? And this is a US exemption on the sanctions, just to be clear, not a global one. So it's not that simple, to say the least, but good luck to the lawyers. So let's just try and do something here that nobody else is doing about this conflict. Let's assume that Trump isn't stupid. He's hurt China by capturing Venezuela. And from a neutral standpoint, if you accept America as the strongest global power, which they are, you have to concede the current Venezuela situation is more acceptable, certainly to America, than it was a few months ago. Too close to home to be a China puppet. Now stay with me for a moment. Probably with the wind behind them, buoyed by this easy extraction that took place and listening to their own rhetoric a bit too much, then comes a bit of a Putin move, I think. Yes, sir, we'll be in and out of Iran in a week and it'll all be done. We'll just do what we did last June. The regime will fall. The people will rise up because that's what they're trying to do. Except they haven't. However, hurting Iran also hurts a Chinese supply of cheaper oil as well. So two major blows for their frenemies. And what have China done? Well, largely speaking, they've remained silent. So is Trump maybe thinking he can turn Russia and get them on side and end the Ukraine conflict all in one go? Well, if that is the thinking, it's incredibly high risk, daring and nuts all at the same time. And they've also hurt the only real rival the US has got in the world at the moment, because he really does care about supremacy and who is number one and that relative difference between the two. So is that too many conspiracy theories and podcasts that I've been listening to? Not really. I've hardly listened to anything on the subject, to be honest with you. That's all from the workings of my own brain. But all I'm looking to do is thinking about what they might be thinking, because I do think there is some kind of plan, even though it seems quite crazy. One thing's for sure, though, it's very clear why he was in such a hurry to try and win the Nobel Peace Prize last year at this point in time. Now, lucky for us, we can retreat to the safety of the UK real-time property market. Chris Watkins' analysis and roundup of week 9 of the UK property market. Well, Chris runs Sunday to Sunday, so this was about the week ending the 8th of March. We're still ahead of 2025 in listings for one more week, and there was a big number that came out. Over 40,000 listings on the market this week. Average week 9 about 35,500, so about 15% ahead of the last 10-year average. So that's a significant number. Right? No two ways about it. And 322,000 houses this year, homes have so far gone on the market, 1% ahead of 25, 9% ahead of 24, 20% ahead of the pre-COVID average. So this is a glut of listings, and it is persisting. And I don't know how much longer we can try and blame the budget for, apart from anything else. There's more stock on the market. It must be landlord disposals, but at least we know landlords are trying to dispose. When they can't dispose, what do they then do? They still rent them back into the market again, because they've only got really three choices, haven't they? Sell at a price they're not happy with, or they think they're giving it away at. They can re-rent it again, or they can actually sell it and live with the haircut they might feel they might be taking. Everybody always thinks their assets are worth more than they are, let's face it. So you do need to be quite pragmatic in these situations if you are disposing. If you want to sell, if you're a motivated seller, you might have heard much over the years about trying to buy from motivated sellers. You might become a motivated seller yourself. That's okay. You just got to do your best and look for the best option. But that other option of renting it again perhaps speaks as to why there isn't a massive drop in the supply of rental units that has been expected. And when you put into context that only 34% of homes that get listed in inner London actually sell, 1 in 3, I mean, it's ridiculous. What do you think are happening to the other 2 in 3? Are they just sitting there long-term empty? Of course they're not. If someone needs to move on, ultimately they might rent wherever their new destination is whilst they rent their property out. They might rent theirs out. It might have been an asset they were disposing of because it was a second property in the first place. Who knows? There's all sorts of situations that go on, aren't there? But what we know is listings are 13.2% higher year to date than the 10-year average, and 15% ahead last week. And remember, only just over 50%, about 53% of what gets listed actually sells. So might explain a bit about the rental market supply not collapsing, as some of the articles, the doomsayers have been suggesting might happen, thanks to renters' rights, thanks to all the other things that are going on. Gross sales nearly 220,000, 9% higher than 2024, 5.7% lower than 2025. Is that something for us to worry about? Still not sure about comparing this year to last year because of the stamp duty deadline. So we're not going to sort of rush into that. What we know is it's still 9% more buoyant than it was in 2024. But you've got all these extra properties on the market, right? And I'll talk a bit about the actual context of those numbers later on. Net sales 8.6% ahead of 2024. So it's not like there's a big difference in what's falling through and what are not. Still 15% ahead of the pre-COVID market. So agents books are looking good compared to where they were, apart from anything else. 25% ahead of the 2023 market to this point, but that was about the limpest market we can remember, of course, in the wake of the limp lettuce, as I've taken to calling it. The wilted lettuce, perhaps I'll prefer in future. So another month started with a 10 plus year record of number of homes on the market, apart from anything else. 682,000. We've had this Boxing Day, big record listings, and we've had more listings than we've had the year before. And of course, that's still adding to the stock. Where are the sales pipelines? Well, not as healthy as they were in 2025, but again, stamp duty deadline 31st of March. We've got to let that play out the figures. April 2026 is going to smash 2025 to pieces, because April 25 was very quiet on the back of all those transactions being brought forward to try and meet that 31st of March deadline. So bear that in mind. We won't get too navel gazy with all of that, apart from anything else. But the February 26 sales saw prices per square foot averaging £343.36. So 2.3% ahead of a year ago, very, very close to the current ONS numbers of house price rises at 2.5% was what we saw for 2025, according to the December to December ONS numbers. Now, we're 18.2% ahead of 5 years ago on pricing in that way. Now, a lot of prices are a little bit more ahead of that, but of course it depends where you are in the country, as we've been saying for months and months and months. Ultimately, north versus the south is very different. We know what's going on in London at the moment in terms of prices actually coming down a little bit or a lot. And I saw an article this morning that had been shared by Rod that was about Market Financial Solutions, the bridging lender that went into administration with a £2.2 billion loan book. And that has led to administrators being appointed at a number of properties in prime London, apart from anything else. So those are going to be sold off at a time where stamp duty is extremely high. Lots of people aren't buying in prime London, and that's going to mean some really interesting prices that are going to be paid. I'm sure there's going to be some huge haircuts that are taken on some of those properties. We'll try and follow that story as much as we can, but we'll try and stick to the real numbers as well, rather than the rhetoric, of course, as always. So I always give Chris a weekly shout out and a bit of appreciation for what he does. Chris, really appreciate what you do. Thanks for sharing what you do with all of us. If you fancy being positioned better as a local market expert, whether you're an estate agent or any other kind of property professional, give Chris a shout. But please go to his YouTube, youtube.com/@ChristopherWatkin. Give him a follow and some love. And I can share with you guys as well, live for the first time, I'm going to be on the Property Market Stats show again with Chris in a few weeks' time. So I'm sure you'll be looking forward to that one. I certainly am. So what have we got in week 2 of March in terms of the macro reporting that we had? We've got the RICS residential market report to talk about, GDP growth report for January, and the Zoopla Home Track UK rental market index. And then, of course, our dessert to our macro feast is always the gilts and the swaps. That slot's not going to be going anywhere soon. So February's market report from the RICS, well, never happy. And the strap line before Iran, remember, was that market confidence remains fragile. They did describe intensifying macro headwinds clouding the outlook, and they do seem to have written a bit of this report in March because they have factored in a bit of what geopolitically is going on, apart from anything else. But they collect the data in February. I'd rather they didn't do that, to be honest, because the pedant in me says that's not really consistent enough. If you collect in February, you should write about February. It is titled February's report, but you can understand why they do, because it is a major event that's going on at the moment. So what do they say? Well, clouding the outlook, buyer demand dipping amid renewed concerns over the interest rate outlook. I can't quite get my head around this, to be honest with you, because if you think rates are going to go up from here, do you then not buy a house? Don't you just get on with it and buy one more quickly and secure a rate? A little bit like filling the car up before everything goes up at the pumps. Obviously a bit different transaction wise, apart from anything else, but 2-year pricing is important to first time buyers, and they love a good old fashioned 2-year. Being optimistic, they think capital growth, they think they might move in 2 years, and if all that goes a bit wonky donkey over the past couple of weeks, that isn't going to help. But then that is February, right? Are you really buying at the moment when you think the rate is going to go down over the next 12 months? But then pre-Iran, the market thought 3.75% base rate in 3 years' time, and 4% in 5 years' time. Now, I know no one's been talking about that at all because they don't want to pretend that the cutting cycle is over or was coming to an end, even though I've been saying that for a whole number of months. But ultimately, that is where the market curves were. That is where the OIS, the forward curves were before all this blew up, right? If you give me that poetic license. Headline house prices remain broadly flat. Regional divergence is evident. That's the language they go for. As I say, made no secret for years that the North has been drastically outperforming the South in capital growth. And there are other reasons for that, aside from a levelling up sort of perspective. Apart from anything else, if you're buying investment property at the moment, unless you can put in some serious value add in the south of the country, or you're doing HMO, short let, you're layering on some kind of value, ultimately, in the north is the only place where you can get standard buy-to-let yield, realistically, in the North and the Midlands. It's very, very difficult to do that in the southeast if you're using any form of leverage or any leverage at a meaningful level anyway, anything above, say, 50%. Very difficult to buy standard buy-to-let in the southeast especially, and in the east as well. So current market reaction, well, I think limited disturbance, to be honest with you. I mean, I watch the swap curves as closely as anybody who isn't a professional swap trader or a mortgage broker. And buyer inquiries were down in February. There's no two ways about it. And I have got in the back of my mind as well at the moment this 60,000 mortgage approval number in January. That wasn't really expected. I didn't see it coming. I talked last week about how difficult it is to compare January over the last 6 years, realistically, because so many different things have been going on. A lot of it pandemic inspired, of course, but some of it budget inspired other than anything else. But it was a surprise drop, and it was the lowest print for 2 years in that Bank of England Money and Credit Report when it comes to the number of mortgage approvals that there were. So will Iran end up being the excuse or the whipping boy here rather than a reason? And were we already into a slowdown? It's a question I'm starting to ask myself, but I don't get overly excited by 1 week or 1 month's worth of data. The whole point is putting it all together, having a bit of a jigsaw, and then making it make sense, right? So now, if you're reading in this in the southeast, or if you're listening to this in the southeast, you might spit the coffee out at this point, because you might well quite comfortably say to me, look, what about this slowdown that's now starting? It's already slow, mate. It's been slow for some time. You might say that in a London, Kent or Essex accent, or other counties are of course available. And it would be a fair comment, but it's all relative, remember, because it always is. Rental side sees landlord instructions comfortably down, balance of minus 27% in the RICS report, plus 20% still see rents moving upwards over the next 3 months, although there has been a bit of evidence to the contrary this week. So to an extent, the RICS report is more of the same, but we do need to keep our eyes on these reports. Now, I'm always watching RICS apart from anything else. What about growth? Well, I can't do another magnifying glass gag. I've done too many of them over the past year and a half. But the year-on-year growth figure, just after I'd eaten my humble pie for getting it wrong in 2025, printed 0.8 on the year, which is smack on my prediction after the 2024 budget. I was a whole month out apart from anything else. But January looked so good on the PMIs, so it was a bit of a surprise to print 0% for growth. Inflation had abated a little bit back then, and the economists expected 0.2 for the month, so a sizable downside miss. Although I've talked before about the folly and the difficulty of trying to predict growth month to month, very difficult. So where are the scraps? Well, there was a revision upwards in the 3 months to November, went from minus 0.1 to 0%. So we found something down the back of the sofa there. These revisions are in the tune of about £3 billion on GDP. So they're not small, but they're the smallest we measure. And we don't talk about the 0.01s in growth, although the ONS does measure them. Of course it does. Services grew 0.2 in that quarter, production 1.3, but construction shrank by 2%, which won't be a surprise to anyone in the industry. But what can we pull out from the report below? The strap lines, employment activities down 5.7, largest single industry negative contribution to real growth in January 26. Not a great start for the jobs market, according to the ONS. From January 24, the index for employment activities is down 8.1% in the growth figures. But getting into construction figures in detail, the index on new work is still 6.9% down on 2023's activity levels. Now remember, a lot of 2023's activity levels were decided in 2022 and 2021 when the market was a lot hotter pre the lettuce, apart from anything else. But repairs are up 12.6%. So repair don't build new looks like a solution that's being followed at the moment. Very typical when investment dries up, apart from anything else. And very miserable, given that the PMI for January is 54. I know it doesn't always fall together, but let's remember one basic thing that a few commentators often forget or don't even know in the first place. GDP is quoted after it's been adjusted for inflation. Real GDP is the long form technical term. It is a rarity, but it's why it catches some people out. If we talked about nominal GDP, we'd be going around saying, oh, the UK has grown at 4% and things like that because it's been adjusted for that much inflation. And 4% sounds a lot better than 0.8, doesn't it? But that's the way it gets done, apart from anything else. So if it was 4%, real GDP is going to go down to 0.5% if inflation is back up to 3.5% or more. I mean, we've been talking about April's number coming down to 2%. That's what the Bank of England has said. That's what the OBR have said. They've softened that position a little bit. I said I was sceptical, not because I predicted what's going on in Iran, apart from anything else, but boring old me has been saying for the last number of months, the risks are to the upside in these situations. And once again, those upside risks in terms of the interest rate, in terms of inflation, are being realised ultimately. So, you might have heard me talk before about war and GDP. It does increase GDP, but it does increase it at a cost. Spending on defence, which is ever more critical in the 2020s and the 2026 world, apart from anything else. But that doesn't provide great returns to the Treasury. It returns about half to the Treasury of what is spent by the Treasury, which is not great. You compare that to infrastructure investment, where it would return more like double to the Treasury over the course of time. And you see why infrastructure investment good, defence spending bad, but when you need it, critical. I'm solely talking from an economic perspective. Please bear in mind, folks. So that's cheered everybody up, especially Rachel. But let's move on to the Home Track Rental Market Index. Their inflation figure on new lets in the UK, according to them, 1.9%. So this is like almost all figures, as I was saying earlier, quoted nominally. So after inflation, down. After the people's wage increases, that number's actually going to be a little bit cheaper. Rent a little bit more affordable. Rental demand down 14% year on year. Blimey, time to panic? Well, not yet. 11% more homes for rent year on year, we're told. Should we panic now? Well, still not yet. Okay, what's going on? Well, the rental market, Home Track define this, as moving towards a better balance, which I'd agree with. Demand down, supply up. Inquiries per property a 6-year low of 4.8. That was 6.5 12 months ago. Rental supply still 23% below pre-pandemic levels. There's the soother. Weaker demand is driving a slowdown, but more supply is still needed to deliver long-term improvements for renters, according to Zoopla and Richard Donald, their Exec Director of Research. And I'd agree with that. So what's with this big year-on-year shift? I thought landlords were selling up. Well, net migration is down really sharply. I even listened to an IFS podcast suggesting that it might be negative at the moment. First-time buyers up, as discussed many times on here recently. 75% of first-time buyers are renters. Supply also up because some who can't sell their homes. Remember these ridiculous stats that 55% of listings sell, or even less than that, as I said earlier on, turning to rents as an alternative. But earnings are rising twice as fast as rents. That improves affordability. So it does help, right? 20 days to rent a property out, and that would be from listing it to agreeing a tenancy, not from tenant moving in, please bear in mind. Looks bad compared to 13 or 14 in 2022 and 2023, when people preferred to rent to take cover from mortgage rates, and also migration was very high indeed. But in the stable old days, it was 23, 24 days. This is from listing to let agreed, for reference. Zoopla measures the rent for a typical property versus average gross annual earnings for a single person. I'd probably argue that methodology, to be honest, but if they're consistent over time, you can run with it. It's 33.5% at the moment outside London, compared to over 35% in 2023. Now, the reason I'd argue with it is, apart from anything else, a single person doesn't need a 3-bed semi, ultimately, apart from anything else. So don't look at the average property versus a single person. I'd look at the average rental household, personally, the average household, real household disposable income, which I've talked about before. Very much my preferred metric on that subject. But the long run average, compared to that 33.5% outside of London, is 33%. So very close to the long run average. It was 35% in 2023, and that was a 20-year high. But the rhetoric over rents being crazy, unaffordable, and everything else is just that. It's rhetoric, ultimately. And this is new lets, remember. Existing lets almost always trade at a bit of a discount. That discount, last time we looked at it, was actually 13%, apart apart from anything else. So a significant discount for tenants who've been in situ for some time. Liverpool and Newcastle are the two cities that win the Zoopla rent rise prize, 4.6 and 4.5 respectively. Bournemouth, Nottingham and Birmingham, unusual bedfellows, all posted lower rents compared to 12 months before, between 0.7 and 1.1% lower. Remember, these are asking rents, not actual rents. So the Zoopla figure for 2026, 2 to 3% is where they think rents will go. Always a good report, well explained conclusions, and generally well defended by the commentary that Richard Donald puts out on it. But always worth a read, right? Gilts and swaps, though. Well, last Monday started with a complete bloodbath. Those of us who were on the red eye to MIP which actually highly recommended, it was far better than I thought it would be, to be honest with you, was sweating the swap rate when they landed, queuing in that bonus queue we now have to queue in because we're not in the EU anymore, watching all the EU citizens glide past quickly while we wait for about an hour to be processed. But there we go, Brexit benefits and all the rest of it. So there wasn't really anything we could do about it. We're watching the swap rate without much we could do, but it was looking parabolic. And at least 3 SOS messages have been out in the past week saying lock the prices in now. I obviously said it a couple of weeks ago, and I've had a few messages prompting me for thanking me for highlighting it. Not quite as good as the 2022 rate call that I made, but it sounds like it saved a few people a few quid, and that's ultimately the objective of doing this. So just like the oil at the pumps, there's still money in the lenders' tanks that was secured at prices below the current market price. But then, like the garages and the supermarkets, they look at their replacement cost rather than the net cost of stock. And yes, of course, they do pocket the difference. So a shout out to those who were so generous this week with their time and their networks as I broke my MIPIM duck. You know who you are, and I know you'll be listening to this. So I thank you very much. It's also worth saying, in fairness, that pulling rates is not the same as repricing them massively upwards. Pulling them is simply a reaction to these rates are moving very quickly. There's a lot of volatility. We don't want to be taking new applications for a day, for a week, for however long it needs before we get a bit less volatility. And unfortunately, on the yields, the black armbands stay on from last week. 4.231% was the open last week on the 5-year. Closed at 4.35, but very volatile. Actually dipped back under 4% on Tuesday after there was a big rally in the bonds and a big drop in the oil price, but that was short-lived. So 12 bips on the fire for the week, 1/8 of 1%. And the 30s lost exactly the same amount of ground, from 5.381 to 5.501. So back above the 5.5 handle. Chunky, right? But back to the growth section, these are nominal yields, remember, in a time where inflation might scream forward, especially if Mohamed El-Erian was right with his analysis that I shared earlier on. So in the real world, the yield curves actually look the same as they did 12 months ago. So we've lost that downward momentum. We lost the progress we've made in the past 12 months. The 30s look bad in all worlds, back near that 20-year high, but the 5s are still about 1.3% below the 2007 highs. So everybody seems to love a lettuce comparison here, and I'm going to give you the important tail of the tape, the real one, rather than people doing this and really misleading people, I think, apart from anything else. The 5-year gilt on the 1st of July 2022 was 1.776% yield, right? Some of us were screaming, take the price. You might remember if you've been a long-term listener. And that moved to 3.971 on the 1st of October 2022. So 3 months, 1.776 to 3.971. Can I just impress on you how utterly intergalactic a move like that is? Here, we've gone from trading in a range of about 3.75 to 4 to up to 4.35, right? So it's a very minor tremor in that sort of context. It's still higher than when Liz was in her pomp, but it's the delta of the move that we've got to consider, right? It's not the actual price itself. Now, I think the world has more accepted what I've been saying for years in terms of the fact we're back to normal interest rates. It's a move. It's still a bigger move than bond traders like, than people who hold bonds like. It's supposed to be low volatility, apart from anything else. But ultimately, this is where we are. That's the context for you, apart from anything else. Now, the shorter dated bonds are more volatile. And the 2 years are relevant, as I know some people want to look at 2-year fixes. And the 2s have gone from 3.51 to 4.141. So that's a 65 bip slip, apart from anything else, since the end of February. Now, in 2007, that was over 5.75. So we're at a nasty but not terrible stage, apart from anything else. there's only one thing I can say here ultimately: keep calm and carry on. If your business model is built on waiting for cheaper debt, I've been saying it for years now, move on. Change the model. Kill or cure. Kill, sell it, cure, asset manage effectively. Keep it if you already cured it, right? If it doesn't need curing, for sure. This is the new world. I've been saying it for 5 years or more at this point. The risks still remain to the upside. One slight rider though, remember, never waste a good crisis. You'll have heard that phrase before, I'm sure. The Labour Party is busy wasting this crisis as usual. What good ideas have I heard this week? Well, war bonds would be a workable one. In the same way that I've mentioned over the years, Mr. Sunak should have raised significant debt in early 2021 under the basis of coronavirus bonds. Quite a few countries did this, right? This wasn't like an idea we had to come up with out of nowhere. Austria sold some 100-year bonds at a very, very, very low yield. It would have been an excellent way to do it. Nominal yields, right? Debt with a specific purpose, right? How would you incentivize domestic investors? Well, how about making them inheritance tax free for residents of the UK, right? I'm not really seeing much of a downside in those really, but just don't do them as in what they call linkers, index linked to inflation, right? For goodness sake, send them out there as nominal bonds. There'll be plenty of people who are drastically incentivized for that. Not my idea, an idea that I heard discussed on a podcast. What about the swaps then? Well, last traded for Thursday last week, 3.991. 12 months ago, 3.964. Same old story, same as it was a year ago. 1 month ago, though, 3.589. So we've lost 40 bips on the 5-year and 51 bips on the 2-year within a month. Well, that's the technicals, but what now for the interest rate? Well, buckle up, folks. We might have seen the last rate cut for this cycle. Or if you prefer, the next move the Bank of England makes might be a rate hike when it moves the rate again, not a cut. I'm fully expecting now, this is being recorded a few hours before the Bank of England meeting on Thursday, but ultimately the expectation will be they will hold the rate and wait and see. Central bankers love an excuse to wait and see apart from anything else, but it's probably the right call today and wait another 6-7 weeks to the next meeting. So El Arian thinks that the central banker's only option is a rise in the UK. In the US it's a bit different because they have a dual mandate. It's not just about inflation, it's also directly about unemployment. They're not having a great time on their job figures there either, whether it's AI sponsored, whether it's just the cyclical nature of the COVID cycle, whether it's pushing up in minimum wages, much more pronounced in the UK than it has been in the US, apart from anything else. But, he thinks you could see rates up in the UK relatively soon, probably May meeting, apart from anything else, and then rates down at the Federal Reserve meeting at the same time. Now, some would argue that this way round, Donald Trump has finally got what he's wanted for some time, forcing the Fed to take action. But by doing that, by making more people unemployed, does not strike me as a great tactic to do very well in the midterm elections, especially when you put it alongside $5 at the pump for a gallon of fuel. The US are exactly the same as the UK like that, but of course it's used to being cheaper over there. But of course you need much more fuel in the US. It's so much of a bigger country. You don't walk to the corner shop in the US, you drive there because it's a long way away, right? It's not really round the corner. So prepare for May's Bank of England monetary policy report because it's going to be a tough one for them to write apart from anything else. Okay, let's put our scuba masks on for our deep dive. And we look, as has become more usual, at 4 different reports. Firstly, I've got a summary of the slide deck that was produced by Neil Hudson at Built Place. If you haven't heard of Built Place, I'd highly recommend going and checking it out. This is based on the mortgage lending statistics. Then we'll look at capping ground rents and who's really going to benefit from a lobby group or an interested think tank, just bear in mind. We then look at a recently released report from LPDF and Savills about introducing demand support, so think help to buy when you hear that phrase. Then we're going to finish off with a summary of a newer ONS report about the current state of the UK economy, which I thought would provide some helpful and objective commentary, since I regularly get frustrated with people misquoting how we're actually doing as an economy. So these MLAR statistics for Q4 2025, the first theme was the resurgence in gross lending volumes. So in summary, according to the Bank of England and the MLAR FCA statistics, gross mortgage advances reached nearly 300 billion, 296 billion in the year to Q4 2025. Marginally higher than the Bank of England's own gross lending statistic of 291 billion for the same period. But looking specifically at the final quarter, gross advances in Q4 2025 were 15.4% up when compared to Q4 2024. New commitments reflect a strong focus on property acquisition, 63% of these commitments designated for house purchases, and a breakdown of the gross advances by value during Q4 2025 highlights that first-time buyers accounted for 28.6% and other owner-occupiers made up 33%. So, remortgaging activity 25.4% and the buy-to-let sector 8.4% of that total. That breakdown is always really valuable. When it's been roaring, the buy-to-let sector well above 15% apart from anything else. So 8.4 historically pretty low. So my perspective on all of this, let's get through any of the headline euphoria, right? 15% year-on-year jump in gross advances sounds fantastic on the spreadsheet, but let's contextualise this against the wider macroeconomic reality. Significant inflation, so we're lending more, substantially more nominal currency just to do a similar volume of transactions. We have to bear that in mind. You know, a few percent inflation has to come off that figure, but this red flag in this data set is this 8.4% for buy-to-let. This seems like a sector practically on its knees from that number, battered by years of tax changes, legislative hostility, which you'll know about, I'm sure, and higher swap rates eroding yield margins to the point of irrelevance. This is going to structural shift in housing provision, right? Private rental sector is shrinking because the math doesn't work for leveraged investors anymore. It's somehow being held together by this longer form disposal, the great condensation, I've called it today in a video on my AI channel, which you can go and check out. It's absolutely what's going on. Capital's being deployed, but heavily skewed towards owner-occupiers. So rental supply crisis, it doesn't look good over the next few years. And when people are turning around going, oh, why haven't we got any rental units? This sell-off won't have been quick and marked and easy to see. Property moves slowly. People try and sell, then they'll rent it. They'll probably go through a tenancy cycle, then they'll try and sell it again. Some of those will be caught up. Some of those will organically be sold because the owner of that asset passes away in that next cycle. It's about what gets replaced ultimately in these situations. They're not getting replaced by big build to rent stuff. They are getting replaced by some institutional and corporate purchases. They absolutely are. But are they 8.4% for buy to let? Are they ultimately replacing them in enough volume? When you hear figures like 1 in 3 properties in London that were on the market were ex-rentals, you really wouldn't think so. Doing those real numbers is difficult. And as I say, it might be next year's housing survey or even the year after that starts to play out in. So it's not as clear, but it is very much clear to me in terms of it being a medium-term trend. What about the risk profile? Well, loan to values and income multiples. So what does it say here? 2025 data, the Q4 2025 data, a notable shift in borrower risk profiles and lending multiples. 7.8% of gross advances were issued at a loan to value between 90 and 95. That's the highest for this bracket since 2008. Now, I've got a few perspectives on this, which we'll get to in a short while, but they call this the extreme end of the spectrum, and this is still not 95% and beyond, bear in mind, so it really is 90% stuff. Sitting unchanged from the previous quarter above 95%, 95% and above is 0.5%, so 1 in 200 loans, or 1/200th of the total that's lent out is lent at 95% LTV or above. So income assessment metrics is hardly going to build a big problem though, is it, realistically, right? So there's a growing reliance on dual incomes. That won't be a surprise at all. Joint borrowers accounted for 60.4% of gross advances. Off the top of my head, I would have assumed it would be more apart from anything else, but there we go. But that compares to 50.1% in the Q3 of 2007. Regulated gross advances at 3 times a borrower's income has rebounded to 60.4%. So it was only 54.1% in Q1 of 2024. So income multiples are being covered much more easily, right? Loans where income was not evidenced accounted for 0.1% of the market in Q2 2025. So there were a few. Is that a little bit of self-cert going on? But again, 1 in 1,000 of the loans being issued. So don't get your hopes up, folks. What's the Propenomix perspective? Well, I can see the mainstream press, and I've seen articles saying it, 90-95% massively risky lending, blah, blah, blah. Let's take a breath and think about it in a different way. Apart from anything else, the kinder stress tests and the better incomes that people are posting is meaning they can borrow more. What's the bit that's missing? Because that's been a relatively quick shift in the market in the last few years. They haven't necessarily got the deposit. How do you solve that? Ultimately, you solve it by getting a higher loan to value that you can now afford because you've got a better salary. That's one take on it, right? That's another way of looking at reality. So today's stringent affordability testing, just because it's been relaxed a little bit because of what Rachel Reeves said to the FCA last year, is you can't compare that to what happened in 2007. That is intellectually very lazy indeed. You know, non-evidenced income loans are virtually extinct. 0.1% tells you everything you need to know about the regulatory fortress that lenders now operate within. But what truly fascinates me is this joint income dependency hitting 60.4. Affordability is stretched tight. Single income house buyers are rapidly becoming a bit mythological. I still think 40% is high myself. I would have expected that to be different because it doesn't mean it's your life partner or anything else. Quite often I've been in situations in the past where I've co-owned houses, yes, with my brother, yes, with another partner, but I've known plenty of people who've chipped in and three of them have shared a property rather than renting, something like that. But to get on the housing ladder today, it's showing that you need two solid incomes and a decent multiple to make the numbers stack up, but you can do it without a massive deposit, right? And the recovery in loans above 3 times income indicates that buyers are capitulating to the new normal of higher borrowing costs. They're absorbing pain and they're still leveraging up because the alternative, which is renting in a highly competitive supply-starved market, is worse. Even if it is better than 12 months ago, remember how much worse it is than 7 years ago. And then the fixed rate fortress and the reality of arrears. Well, fixed rate products continue to dominate the UK mortgage landscape, comprising 93.2% of gross advances in quarter 4 2025. Now, 95.5% was the peak in quarter 3 2022, but it still pushed the total proportion of outstanding balances that are on a fixed rate to 89.8%. So the average mortgage rate across all outstanding balances has gone to 4.09 in quarter 4 2025, up from the record low of 2.14, which was quarter 4 2021. So from 2.14 to 4.09, basically a 2% rise. Pretty impressive that the market has not largely capitulated or gone backwards, and in many parts of the country has still gone forwards over that period of time, despite that massive repricing. Basically a doubling of the interest rate. 2 going to 4 is a doubling, right? It's not how it works in your residential mortgage payments, because ultimately, apart from anything else, in the resi payments, you're also paying back the capital as well. But still. Regarding financial distress, the number of new loan accounts falling into arrears during quarter 4 was 14,350. That's a 34% drop from the recent peak of 21,567 that was recorded in quarter 3 of 2023. So total cases in arrears, 1.2% of total loan balances. Finally, the number of new possession cases was 2,182, which is 12.1% lower than the preceding quarter. Much prophesied mortgage arrears tsunami has officially failed to materialise. A 34% drop in new arrears from that peak, this is the Propenomix take, is a massive testament to the sheer resilience of the UK consumer and the flexibility of modern lenders. Banks have got no appetite for repossessions. They don't want forbearance. They want term extensions, and they want interest-only switches to keep people in their homes. So with almost 90% of the entire mortgage book locked into fixed rates, that does insulate the market from the immediate sharp shocks of base rate rises. But the average outstanding rate has steadily crept up to that 4.09, meaning the financial pain of refinancing is slowly bleeding into the system rather than hitting everyone at once. And we talked about this years ago, and the Bank of England had done some modelling around it. And actually, we've seen for the first time over the past month, according to the Bank of England Money and Credit Report, that the average balance, that 4.09, is down from what was 4.12. So actually what's happening is some more expensive 2 years have been dropping off, and then people are moving on to other. Now, Iran and what's happening there is going to affect this, of course, but that will take months. That will be months and months before we see that actually play out on mortgages offered and actually executed on and completed. So you never really see in these situations, and it does irk me, any praise for a job that's been well done apart from anything else. But the 2012 mortgage market review really was exactly that, because we've just survived a significant period of stress. Extreme but time-limited stress was effectively self-inflicted by the Lettuce budget of 2022, and then pressure on the 5-year rates around the middle of 2023 as interest rates truly normalised. And then we got into the new world scenario, and the 5-year gilt very, very, very nearly hit 5%, if you remember that time. When 2022 to 25 becomes true history rather than just recent past, Commentators will look back, in my opinion, and they will comment on just how incredibly resilient the UK housing market was as we moved from 2% to 4% via 6% rates very briefly, apart from anything else. It's incredible that we've seen such gentle movements in nominal pricing, and inflation in many ways has helped. So, moving on to ground rents and the cap, then the £250 cap. Cui bono, we should always ask ourselves in these situations. That is Latin for who benefits. Landlords, as it turns out, make no mistake, the Residential Freeholders Association is directed by the chief exec of a big freeholder, so we don't need to look too far as to work out what the incentives might be of producing a report like this, but it is a factual report, and that's why I thought it was worth sharing. So theme 1, the buy-to-let windfall, this £250 proposed cap on ground rents simply inadvertently benefits property investors rather than owner-occupiers. An independent economic analysis published indicated that the policy would deliver 8.7 billion windfall to landlords. Government data indicates that 41% of leasehold properties are privately rented. Consequently, the direct benefit of the cap falls on property investors, particularly in London and the South East, which account for around 55% of the total benefit. Valuation modelling highlights staggering potential gains in prime London developments. For example, a single landlord at Hanover Terrace NW1 might gain over £420,000. Conversely, the average leaseholder paying around £304 in ground rent would see only limited savings. Lower ground rents are also going to be reflected in higher property prices, which will raise the barrier for first-time buyers, is the argument. Now, look at the state of the policy making here. It was always difficult. It was difficult for Michael Gove. It's still difficult, but it's been pushed through by this Labour administration. But, you know, the headline objective was a lifeline for the ordinary leaseholder battling the cost of living. In fact, it's just a massive check to really, really wealthy people already from other really, really wealthy people in the real world, right? You know, 420 grand to a landlord or someone renting out a £10 million flat in NW1. It's not the assignment, was it, realistically? But it's classic political theatre. It's targeting the populist villain, but shooting yourself in the foot. Lowering ground rents is just artificially going to pump up the capital values of these properties, which is raising those barriers for the first-time buyers that the government claims to support. The average owner-occupier gets a few pennies. The prime London buy-to-let market gets a massive unearned bonus. Now, you might say to me they need that at the moment, and you wouldn't necessarily be far wrong, but it's an extraordinary misallocation of wealth orchestrated by a fundamental misunderstanding of market mechanics. But then again, maybe the London market needs all the pumping it can get at the moment, but super prime just doesn't move the needle in the normal market apart from anything else. It's just a different divorced market altogether. It does not trickle down, folks. Theme 2, the hit to investor confidence then. So this WPI strategy report that was produced highlights several severe macroeconomic consequences from this retrospective cap. So 18.7 billion off the value of ground rent investments, equivalent to 0.6% of GDP, and it could reduce total business investment by up to 9 billion a year, the report claims. This reduction is why? Because it's driven by investors factoring in policy uncertainty and undermining confidence in the UK's policy framework. So experts are warning of spillovers beyond housing because long-term rules and commitments might also be retrospectively changed. And if you do look back over the years, apart from the very famous Section 24, which of course was retrospective to property owners in their personal name, generally speaking, we tried to steer clear. And what happened after Section 24? You know, buy-to-let was going like that, and then it started going like that, and very slightly downwards in terms of supply. It had the intended effect, but that intended effect was stark. This is not the same. This is not about a tax collection, a move from discouraging small landlords. It's not about any of that stuff, right? So it will also hit ordinary pension savers. Now, I did a bit of work on this some time back, and it was looking at maybe 10 or 15% was going to hit pensions. So it's not a small amount of money, but it's not huge. The vast majority, certainly over 50% of it, will be absorbed by private equity and private investors. So there won't be too many violins out for them in terms of the consequences. But I do think, from my own personal take on this, that the policy point is a valid one, ultimately. If people are going to go around changing things, this capital is mobile. It will go worldwide. It may well go somewhere else apart from anything else. So, you know, if you're avoiding a long-term agreement on a political whim, you are adding a massive risk premium to every single asset class in this country. You know, we're busy begging for 50 billion long-term investment from pension funds through the Mansion House Accord, but then also we're pulling the rug under the residential freehold market. It just doesn't seem very congruent and coherent apart from anything else, right? Gilt yields and borrowing costs will inevitably reflect this risk premium. If contract law is no longer sacred in the UK, why on earth would global capital park its money here, apart from anything else? We sound like we might be closed for serious long-term business, and that's the risk that's being highlighted here. So theme number 3 is the threat to housing supply. So this ground rent cap is direct conflict with wider government objectives about 1.5 million homes and all the rest of it. The analysis has suggested we might see 15 to 20,000 fewer homes created every year on the back of this cap. And the Residential Freehold Association argues these retrospective changes reduces housing supply. WPI strategy note that the slowdown in delivery of new homes comes at a point when house building sector is already under pressure, high-risk buildings, gateways, all the rest of it. Industry leaders support reform for transparency and standard raising, provided it does not undermine long-term economic goals. So let me get this straight. We've got a supposed target to build 1.5 million homes, and the government's own proposed legislation is projected to kill up to 20,000 housing starts a year right out of the gate. Well, you couldn't make it up. House builders are already strangled by planning delays, nutrient neutrality absurdity, and elevated debt costs tied to stubborn SONIA swap rates. Adding a completely avoidable hit to investor confidence is pure economic vandalism. If you're going to fund large-scale high-density development, which is the development we actually need and we're really struggling with at the moment, you need forward funding and institutional backing. If you nuke the viability of the freehold investment model, the capital for new block developments may well evaporate, right? We're sacrificing essential housing supply on the altar of a pretty poorly thought out headline grab, really. But look, it's happening, and if we layer any more woes onto the woes of a deemed high-risk building, this is certainly going to be one of them. Cui bono, as I said, my friends. Okay, let's move on to help to buy and any other demand support. So first theme in this report, the SME house builder crisis and the two-tier market. So we've got a stark divergence in the fortunes of UK house builders based on their size. The average sales rate reported by PLC house builders remained relatively stable, 0.57 homes a week in the second half of 2025. But smaller firms delivering fewer than 1,000 homes per year have had no such recovery in their sales rates over recent months. That mid-sized tier, who are delivering maybe between 500 and 1,000 homes annually, has actually been hit the hardest. They were doing 33 sales a year in 2021. They sold 19 in 2025. That's a 40% decline. So, and you can see 19 well under 0.5 apart from anything else. So SME developers are capturing an increasingly small share of the overall new build market. Larger PLCs are maintaining volumes by using sales incentives, a cost that smaller builders just do not have the financial capacity to absorb. So I look at these numbers and I see exactly what we've been worrying and warning about for the last few years. We don't have a housing market. We have a two-tier oligopoly which masquerades as one. PLCs float along on their 0.57 sales rate. They've got the balance sheet density to buy volume with heavy incentives. The SMEs are being crushed because the cost of capital is fundamentally broken for them. When you look at the swap markets and commercial lending rates, debt financing for a site of 50 units is painfully expensive. If an SME cannot turn capital quickly, and at 19 sales per outlet a year they cannot, their internal rate of return evaporates. The government loves to talk about diversifying the supply base, but until we address the prohibitive cost of development finance and the glacial planning system, the top 10 builders will simply continue to eat everybody else's lunch. Theme number 2, the deposit barrier and the rental trap. So first time buyer recent highs we've talked about, but it's still substantially lower than the 1990s levels. So the most significant barrier to home ownership still continues to be the deposit, apart from anything else. And rents are 35% higher than they were in March 2020. That doesn't help renters with saving a deposit, of course. Since the Help to Buy scheme closed in 2022, support for first-time buyers sharply declined, and although you can get the 95% mortgages, as I discussed earlier on, 0.5% of loans are at that sort of level. So the ongoing costs of ownership are comparable to market rent. You know, they look at a £300,000 new home in this report, 95% mortgage, you need a household income of 60k. But an equity loan scheme that allowed for a 5% deposit would reduce the required income to 43k, interestingly enough. And this is the crux of the demand side disaster, right? An entire generation is running on a treadmill that keeps speeding up. Rents up 35 because of structurally constrained supply and driving private landlords out of the market through punitive taxation. Where are they supposed to find a deposit, these buyers, that is equivalent to a full year of gross income while they're paying record high rents? 95% mortgage product is a red herring, as I've said, ultimately. But, you know, you factor in stress testing, current SONIA swap rates, The monthly servicing costs are completely detached from median wages. An equity loan bridges that gap by being that mezzanine tranche of state-sponsored funding. But we'll be using financial engineering to solve a structural supply deficit. Works for the buyer on paper, but it's a damning indictment of our inability to build affordable housing organically. I don't think, though, I can bear one more time to point out why rent compared to mortgage is a bad comparable. Insurance, improvements, compliance, maintenance, all included in rent. Oh, look, I just managed it one more time. But 135 to 150% of rent would be a much better proxy for an equivalent mortgage to allow for 25 to 35% slippage from owning your own house. But bear in mind, in the interests of balance, that would include some capital repayment. Also, so you would also be doing some saving, although that would be very little in the first 5 or even 10 years of a 35 plus year term, because your capital contributions are very low in the early part of a mortgage. Theme 3 here, the economic pitch for demand support. Well, a renewed equity scheme, the research shows, could have a profound impact on both the housing sector and the wider economy. 1 in 4 family households live in a private rented accommodation. About 375,000 families could afford to buy a home with an equity loan as a 5% deposit, but they couldn't do the 95% loan-to-value mortgage repayments. But this report estimates that about 85,000 additional housing completions could be realised by March 2029 if Help to Buy or similar was reintroduced. So that boost to house building could generate 24 billion in GDP over 3 years. Not small, right? So to maximise this impact, the report advises against regional price caps, noting that new build prices vary substantially even within individual regions. So any cap should be set at a local authority level. My perspective, well, it's a classic pitch for the demand side stimulus. It's music for politicians' ears. Just subsidise the buyers and we'll build our way to 24 billion in GDP growth. I don't dispute the mathematics, but injecting that much liquidity on the bottom rung of the housing ladder will absolutely spur transactions. But we do have to look at the macro reality. If you pump billions into demand without fundamentally reforming the supply side, a significant portion of that capital simply capitalises into higher land values and house prices, and it does what we saw in the 2010s. It drops onto the P&Ls and the balance sheets of the big house builders. It's exactly what happened in the first iteration of Help to Buy. Furthermore, at a time when gilt yields are highly sensitive to government borrowing, creating a massive new contingent liability on the state's balance sheet is not without its risks. But I do completely agree with scrapping of the regional price caps, because local authority level data is the only metric that reflects reality. But we must remember that an equity loan is a painkiller, not a cure for the UK's terminal housing disease. Now we're going to finish with a roundup on the UK economy from the ONS and my take on it. So, theme 1 here is the illusion of GDP growth. The latest data from the Office for National Statistics indicates that UK gross domestic product is estimated to have increased by 0.1% in quarter 4 of 2025. That mirrors the marginal increase of 0.1 in the quarter before that. But top-level growth, if you can call it that, masks underlying weakness in individual prosperity. Real GDP per head has fallen for the second consecutive quarter by 0.1%. Sector performance was highly varied. Growth was driven by a 1.2% increase in production, but construction was down 2.1% and services showed no growth at all. So let's cut through the noise. 0.1% uptick in GDP is nothing to celebrate when per capita is going backwards. This is officially now a per capita recession, because we've had 2 quarters in a row of per capita income shrinking. Right? The average person in the UK is getting poorer, despite any vanity metrics or political rhetoric trying to suggest otherwise. And as property investors, the glaring red flag here is the 2.1% contraction in the construction sector. Bank of England dithers over the swap rates and the broader gilt market tries to find its footing, but the reality on the ground is we're not building enough stock. A shrinking construction sector in a country with a chronic structural housing deficit only points in one direction for long-term asset values, upwards. The supply constraints are tightening, and this data proves it. So, sticky inflation and producer costs. Well, inflationary figures show a bit of an easing, or they did, with CPIH, which is the ONS's preferred measure, includes housing costs, recorded at 3.2% in Jan 26, down from 3.6% in December 25. On the production side, producer output at the factory gate prices saw an increase of 2.5% on the year to Jan 26, which is down from a revised rise of 3.1% in the year to December 25. But producer input prices rose by a marginal 0.2% on the year in January 26, So they've managed to recover a bit of that margin they've been losing on increased staff costs, apart from anything else. So, my take on this, well, the mainstream headlines inevitably cheer the drop in CPIH, but the champagne is still on ice, folks, I'm afraid. Central Bank wants us to believe they've slayed the inflation dragon, but looking beneath that bonnet tells a far stickier story still. Producer output prices rising at 2.5, baseline cost of creating physical goods, materials needed to refurbish property or build property, for example, still compounding. Sticky inflation keeps a firm floor under how far base rates can truly fall. If you're sitting on your hands waiting for a return to the days of 1% mortgage rates, you'll be waiting for a very long time. The smart money is locking in fixed debt now and rigorously pricing structurally higher operational and capital expenditure costs in their portfolios. Remember, these figures are all pre-Iran and geopolitical disruption. Theme 3 was the labour market disconnect. So the summary, the UK labour market presenting a mixed picture of rising unemployment alongside robust wage growth. The UK unemployment rate estimated at 5.2, as you'll know, in the period October to December 25, an increase on the previous quarter and on the previous year. Concurrently, though, the UK employment rate was estimated at 75.0 in the same period, which was a decline on the quarter. Now, rising unemployment but rising wages, unusual. Annual growth in employees' average pay in nominal terms 4.2% for both regular pay and total pay in that final quarter of 2025. But this is a real headache for the macroeconomists. Unemployment creeping up, wage growth stubbornly high. Traditional economic models do not provision for this to be happening, right? It reeks of stagflation. For landlords and property developers, this gives us a double-edged sword. On one hand, nominal wage growth of 4.2 means tenant affordability is still expanding, which has got to be seen as a good thing, supporting the current rental market, providing room for necessary yield adjustments. On the other hand, the rising unemployment rate introduces a very real element of systemic risk to the market. If your tenant base is heavily exposed to sectors bleeding jobs, that national average wage growth means absolutely nothing when your specific rent arrears start to spike. Focus heavily on your micro market, underwrite your tenants rigorously, and do not rely on national averages to save a fundamentally bad deal. And then theme number 4, demand and corporate caution. So looking at measures of demand within the economy, retail sales volumes experienced slight growth while corporate investment pulled back. The quantity of goods bought in retail sales is estimated to have risen by 0.1% in the 3 months to January 2026 compared with the previous 3 months. The rise was primarily attributed to better automotive fuel sales and a positive start for the year for non-food stores. Monthly retail sales volumes are estimated to have risen more sharply by 1.8% in January 2026. UK business investment decreased by 2.7% in the quarter 4 of 2025, but business investment is still 2% above the level recorded in the same quarter of 2024. But consumer spending is holding on by a thread, driven largely by people putting petrol in their cars to get to work, but this 2.7% in business investment is not good. Corporations are running scared. When businesses stop investing capital, they stop expanding and then they start shedding staff. The lack of corporate confidence trickles down into the commercial property sector as well, but the residential market isn't far behind as well because ultimately buyers and tenants have jobs. If businesses are hoarding cash rather than deploying it, it tells me they're extremely wary of the current fiscal commitment and potential future tax rates. As property entrepreneurs, we need to take a leaf out of their book. Preserve liquidity, ensure you have robust cash buffers in place, and only deploy capital when the underlying value is undeniable. The era of speculative, highly leveraged punts is dead. There's almost always an alternative for business, and that is wait and see. The war doesn't change that at all. It encourages it more and more. Woe is me? More like slow is me. But as we get to the end for this week, our Manchester Property Business Workshop is continuing to sell very well. This workshop's always in huge demand, and we talk about exit. So we'll cover tax, risk, deal structuring, exit options, not just for you, but for those who you'll be inevitably be dealing with to buy assets, portfolios, companies and the likes from. Can you help them with their exit? I have over the years, often because no real formal plan of their own actually exists. That's meant I've added massive value, and it's enabled me to get deals over the line. Have you got children? Are you planning to leave a legacy? What does your plan look like? Do the kids know about it? Well, they often don't, and spoiler alert, they often don't want to play ball with it either. So as always, we have real life case studies about our own experiences and close with our no holds barred Q&A. Have you got something individual to consider? Get yourself a VIP ticket. Join us for dinner in a smaller setting with an opportunity to discuss specific roadblocks or issues in your property businesses at the moment. The VIP dinner was absolutely incredible in January. We got some superb feedback and the upgrade is well worth it. Now, there are only a couple of super early bird tickets left, so make sure you snag one before they're sold out. And book your tickets for Wednesday, the 22nd of April, Central Manchester, at tinyurl.com/PBWTEN. But please, apart from anything else, always remember to keep calm, listen to the supplement, and carry on, because there will be opportunities around this year, throughout the rest of the golden quarter, towards 2030 and beyond. Our landscape has been set for a surefire bull run. Capital growth is set to remain slowish at the moment for this year, but if you're in the right part of the UK, you may well be well looked after by the combination of that plus inflation. This big bull run needs some new runway first, although let's see what the FCA and PRA do around easing lending requirements again. But let's finish our super golden quarter together. It is a case of here we go, in my opinion.